Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at HP.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for investors who want a faster and cleaner research workflow. You can check out stockanalysis.com Pro through the link below in the description. Use discount code ITP for 10% off. Stockanalysis.com is lightweight, fast, and works on desktop, iOS, and Android. The free version is useful for checking stock prices, financials, charts, forecasts, and news. But if you want deeper research, stockanalysis.com Pro gives you no ads, saved screeners, watch lists, portfolios, long-term financial history, dividend history, analyst filters, ETF data, and exports to Excel, CSV, and Google Sheets. Pro comes down to about $5.93 per month when billed annually after the discount. For heavier users, the unlimited plan adds unlimited downloads and unlimited stocks per watch list, and comes down to about $14.93 per month when billed annually after the discount. Stockanalysis.com is a research tool, not financial advice. It does not tell you what to buy or sell, and it does not guarantee investment results. Always do your own research and make your own investment decisions. This is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
Okay, so let's just unpack this right away, because normally if you look at your portfolio and you think of HP, you are definitely picturing like that beige box sitting under a desk.
Yeah, or the office printer that, constantly jams.
Exactly. The one that always seems to need a new $60 toner cartridge right when you need it most. It's basically the definition of corporate background noise.
Right, a total legacy hardware company.
Yeah, I mean, it's not exactly the kind of stock that keeps tech investors awake at night, sweating with excitement.
No, it's really not. But that's actually exactly what makes the current setup here so fascinating. The market is suddenly waking up to them in a really major way.
Wait, like how major are we talking?
Well, if you haven't been paying attention to it, the numbers might actually shock you. We're looking at a massive 24.35% return in just one single month.
Wow, just 1 month.
Yeah, 1 month. And if you zoom out slightly on the chart, it is a 35.15% return over a 3-month period.
That's not just a little random bump.
Exactly. That is the market signaling a massive fundamental re-rating of the entire company.
Right. But here's what we have to be careful, and why we are taking this deep dive today. A nearly 25% run in 4 weeks for a company that sells printers and laptops.
It sounds a bit crazy, yeah.
It really does. It immediately sets off my alarm bells as an analyst. We really need to figure out what is actually driving this momentum. Like, is this a true sustainable shift in how they do business? Or is it just, short-term hardware hype catching a ride on the broader artificial intelligence wave?
That is the million-dollar question right there.
Because, let's be honest, it is very easy for a company to just slap the letters AI on a press release to juice their stock price. But it's incredibly hard to change the actual financial trajectory of a massive, mature business.
Very true. So to figure out if this is actually real, all right, let's move into the wealth building context.
Right. Because if you look at HP's historical role in a portfolio, it has traditionally been played as a very reliable, very slow growth stock.
Right. You definitely don't buy HP expecting it to double overnight like some tech startup.
No, not at all. You hold it because it is a recognized dividend champion and contender, which means, they have a long proven track record of consistently paying and growing that dividend.
Yeah. And it offers great downside protection during economic downturns because of that reliable free cash flow.
Exactly. In fact, if you look at its 1-year total shareholder return, it's sitting at a very respectable 11.86%. It functions almost like the shock absorber in your investment vehicle.
I like that analogy.
Yeah, it keeps your ride stable, it's predictable, and it generates steady capital.
Right. And that historical stability is the foundation you really need to keep in mind here. But the narrative around that stability is aggressively shifting right now.
How so?
Well, what's happening is that HP is transforming from a purely defensive, kind of boring dividend play into a primed catch-up trade in the AI hardware space.
Ah, okay.
Yeah, we are moving away from the idea of a simple replacement cycle.
Right, which is just when a company buys a new laptop simply because the old one finally broke.
Exactly. We're moving away from that to what we call the structural growth vector.
Wait, before we go further, let's make sure we're totally clear on that term for everyone listening. When you say structural growth vector, you're basically saying this isn't just a temporary spike in sales.
Right. No, not at all.
You're saying this is a permanent foundational shift in how HP makes money and how consumers actually buy their products, right?
Spot on. It's a permanent shift because the introduction of AI directly on the device fundamentally changes why and when consumers and enterprises upgrade.
So it's not just fixing broken hardware anymore.
Exactly. You aren't replacing a broken screen, you are buying a completely new type of tool that changes your entire workflow.
Wow, okay. Well, to see if they can actually pull off that kind of massive transformation, all right, now let's look at the fundamentals.
Good idea.
Because to understand if this growth vector is real, we really need to look at the machinery of the company itself. We are dealing with a market capitalization of roughly $23.8 billion.
And shares were recently trading right around that $26.30 mark.
Right. And the core fundamental strength here, like the thing that keeps their competitors up at night is their massive global installed base. They're just deeply entrenched in both the consumer and enterprise PC and printer markets.
Yeah, they are everywhere.
And that creates a remarkably wide competitive moat. I mean, think about it. When a massive global bank has an entire skyscraper full of HP systems hooked into their secure network, the switching costs are huge.
Oh, massive. To rip all that out, buy Dell or Apple, and then retrain their entire IT staff.
Astronomically high. They just won't do it unless they absolutely have to.
And that massive, sticky installed base is the perfect launch pad for what comes next. If we connect this to the bigger picture, we are seeing a total inflection in their revenue trajectory.
Right, because of the enterprise spending.
Yes, they are actively positioning themselves to capture a massive incoming wave of corporate IT spending. And they are doing it by making a very aggressive move into the premium, high-margin hardware segment.
The premium segment.
Yeah. Have you seen the limited edition Scuderia Ferrari AI PC they just launched?
Okay, hold on. Stop right there. I have seen it, and sure, it's a very striking piece of hardware. But a Ferrari badge and some red paint doesn't change the underlying economics of a $23.8 billion company.
Well, it's more than just a badge.
But PC manufacturing has historically been a brutal race to the bottom. I mean, these companies fight over pennies, slashing prices at Best Buy just to move inventory off the shelves.
That's the old model, though.
Sure, but a premium limited edition laptop is a great marketing stunt for a press release. I just need to see proof that this translates to actual scalable profit margin expansion. Like, can a specialized cooling system really rewrite a legacy hardware company's entire margin profile?
Okay, I hear you. But it's not just about the red paint, right? It's about what the paint represents. It signals a massive shift in their brand positioning.
Okay, I'm listening.
They are combining incredibly advanced thermal cooling systems with highly specialized AI-focused hardware features. So they are deliberately targeting premium buyers, data scientists, and power users.
People who are willing to spend the money.
Exactly. By doing this, they're proving they can command much higher average selling prices. If you can suddenly sell a machine for $2,000 instead of $800, your profit margins expand dramatically.
And it kind of elevates the perception of the entire brand ecosystem, too.
Exactly.
I see the logic, I really do. But knowing they have a massive corporate footprint and a fancy new laptop doesn't automatically mean those corporate clients are actually going to open their wallets and buy them today.
True.
Which means, all right, that brings us to the catalyst timeline.
And this is where the macro forces all collide perfectly for HP. The biggest immediate tailwind driving this entire narrative is what the industry is calling the year of refresh for enterprise IT equipment.
Ah, the refresh cycle.
Right. And this isn't an optional upgrade for these companies.
Right.
It's being violently forced by the calendar. Specifically, the approaching end of support for Windows 10 in October 2025.
Okay, let's unpack the why here for you listening, because this is a crucial point. When Microsoft stops supporting an operating system, it means no more security patches.
Right, which is a big deal.
A huge deal. If you are a hospital or a financial institution, running an unsupported operating system is a massive, massive liability. You will fail your compliance audits instantly, and you are wide open to hackers.
Yeah, it's a nightmare scenario.
So enterprise chief information officers essentially have a gun to their heads. They have absolutely no choice but to upgrade their hardware.
Not at all.
But playing devil's advocate, why does that force them to buy an AI PC specifically? Like, why not just buy a huge batch of cheap, standard laptops to satisfy the security requirement and save money?
Because of future-proofing and Microsoft's new Copilot Plus requirements.
Yeah.
If an enterprise is going to spend millions of dollars replacing 10,000 laptops, they aren't going to buy outdated technology that will be completely obsolete in 2 years.
Okay, that makes sense.
Right. They're going to buy machines capable of running the next generation of software. And here is the absolute game changer for HP, their partnership with NVIDIA.
Oh, wow, yeah.
They are integrating NVIDIA's new RTX Spark chip directly into these new Windows laptops.
And this is where the technology shifts from being an abstract concept in a boardroom to something physical actually sitting on your desk. Why the RTX Spark chip specifically matters is because it's about moving the heavy lifting from the cloud down to the edge. For years, if you wanted to ask an AI a question, your computer had to send that data over the internet to a massive, energy-hungry server farm somewhere out in a desert, process it, and send the answer back.
Which is incredibly inefficient.
Yeah, it takes time, it costs money, and frankly, it's a huge data privacy risk for big corporations.
Right. Moving AI processing from the cloud to the edge, which, just to be clear, just means doing the computing locally on your actual device, changes everything.
It really does.
It reduces latency, so things happen almost instantly. It drastically increases data privacy because your sensitive company data never leaves your laptop. And most importantly for HP, it requires significantly more powerful hardware.
Meaning you need specialized neural processing units, or NPUs.
Yes, exactly.
Which is another term we should quickly demystify. You can think of a standard CPU like a general manager. It's pretty good at managing a bit of everything on your computer. A GPU is like your specialized graphics department. But an NPU is like a hyper-focused mathematician designed specifically to run complex AI algorithms incredibly fast.
And it does it without draining your laptop's battery in 10 minutes, which is key.
Right.
And packing all of that specialized silicon into a laptop opens up a highly speculative but incredibly exciting catalyst for investors. By driving those average selling prices significantly higher, HP could fundamentally alter its profitability.
It changes the math completely.
It does. And looking even further out, there is the potential to monetize this on-device AI through recurring software subscriptions.
Like the Apple model.
Exactly. Think about the ecosystem model Apple has perfected, where the hardware gets you in the door and the software subscriptions milk the profit over the next 5 years.
Okay, but again, this is where we really have to ground this exciting narrative in the actual calendar. The story sounds amazing, but reality hits in late August when HP reports their fiscal Q3 earnings.
Oh, for sure.
That is the moment of truth. I want to see actual hard guidance on AI PC unit shipments. I want proof on the balance sheet that these average selling prices are actually expanding before I completely buy into the hype.
Yeah, you want to see the numbers.
We need to hear the chief financial officer confirm that real companies are actually buying thousands of these premium machines, not just looking at a Ferrari laptop in a glass display case at a tech show.
Which is completely fair, honestly.
Yeah.
But the market isn't waiting for August to make its bet. Now let's pivot to the chart.
Because the price action over the last few weeks is telling a very distinct story about how Wall Street is anticipating those earnings.
It is an incredibly forceful bullish breakout. We aren't just looking at gradual, quiet accumulation here.
Not at all.
We were talking about a 7-day return of 5.16% and that staggering 30-day surge of 24.35%. From a technical perspective, when you see a 3-month return of 35.15%, that typically signals the mid-stage of a major trend reversal.
Because it had been flat for so long.
Right. For a very long time, HP's chart was just moving sideways, building a massive foundation. It was a long period where buyers and sellers were just in equilibrium.
Yeah.
Now, it is violently broken out of that consolidation, which indicates broad, undeniable market interest in any hardware name adjacent to AI.
See, the momentum and the flow here are what catch my analytical eye. While we don't have the specific raw volume numbers stated in millions of shares traded, a 24% monthly run for a massive $23.8 billion company implies unusually high volume.
It has to, yeah.
This is not a bunch of retail day traders pushing the stock up a few cents on Reddit. This implies heavy, sustained institutional accumulation. The big funds, the Vanguards and the Fidelities, are looking at their portfolios, realizing they missed the boat on the hardware side of the AI boom, and they are rapidly shifting their institutional positioning from underweight to overweight.
It's like a compressed spring finally releasing.
Exactly. But, as a word of caution, a chart moving this vertically means the stock is pricing in a lot of good news very quickly. There is absolutely no room for an earnings miss when a stock is run this hot.
So what does market sentiment look like?
Good question.
If you look at the headlines, the mood right now is decisively, unequivocally bullish. The narrative shift has been completely successful. We are seeing Major news titles explicitly crowning HP a big winner following NVIDIA's laptop chip unveiling.
That's a strong phrase, big winner.
It is. That is a massive psychological pivot for the broader market. They have successfully transitioned the public's perception from boring, commoditized printer vendor to innovative AI hardware player.
I hear that, but I like to look for the cracks in the sentiment data.
Of course you do.
Playing the skeptic here. There is a specific nuance in the recent coverage that we really need to pay attention to. While the Ferrari premium push is definitely exciting, some of those very same news titles also mention that it raises investor questions.
Yeah, that phrase.
Right. And if you've been in this game a while, you know that when financial media uses the phrase raises investor questions, it's often a very polite way of saying the market doesn't fully believe you yet. It's a reminder that extreme bullish sentiment can sometimes act as a contrarian indicator, preceding a harsh reality check if the company doesn't execute perfectly on this massive pivot.
And execution is never guaranteed, which is why we have to look at what could go wrong. Now let's talk about the risks.
Because we have to outline the bear case. And the primary issue here is execution risk, specifically regarding software.
Right, the software lag.
Yeah. The entire bullish thesis is built on the assumption that you and I and major enterprises will gladly pay a premium for AI capabilities. But what if the software applications don't actually utilize the on-device AI, that shiny new NPU, in a way that genuinely changes the user experience?
That would be a problem.
A huge problem. What if you buy a $2,000 AI PC, but you still just use it to run basic Excel and check emails? If the software developers lag behind the hardware, the AI PC cycle is just a gimmick.
It becomes a marketing feature rather than a massive necessary upgrade driver.
Exactly. And if that happens, consumers will stop paying the premium, and HP is stuck right back where it started, dealing with standard, low cyclical hardware margins and fighting over pennies with its competitors.
That is a very valid concern. Hardware without killer software is just an expensive paperweight.
And then you have intense big tech competition. HP isn't operating in a vacuum here. Apple is executing an aggressive, deep vertical integration strategy with their M-series chips and the rollout of Apple Intelligence.
Yeah, Apple is a beast.
They control the entire stack. They make the silicon, they build the hardware, and they code the software. That unified memory makes local AI incredibly efficient. HP, on the other hand, relies on a fragmented ecosystem of Microsoft software, NVIDIA chips, and Intel processors.
It's definitely more complicated for them.
And meanwhile, on the enterprise side, Dell is absolutely surging, recently posting 88% year-over-year growth in AI hardware revenue. HP is fighting a brutal war on two fronts against absolute giants.
They are, but here is why that competition risk might actually be manageable for you as an investor, and it all comes down to valuation.
Okay, let's hear it.
At a $23.8 billion market cap, a significant amount of that big tech competition risk is already priced into HP's historical multiples. You are not paying a massive premium for absolute perfection here, like you might with other high-flying tech darlings.
That's a fair point. The downside is largely protected by its value stock characteristics.
Exactly. Furthermore, the NVIDIA RTX Spark partnership and the premium Ferrari collaboration aren't just empty marketing stunts. They're direct, highly effective countermoves to Apple's walled garden and Dell's enterprise push.
So you think they can hold their own?
I do. By partnering with the undisputed leader in AI chips, NVIDIA HP is ensuring they have best-in-class processing power on their devices. This means the actual AI upside potential for HP is only just beginning to be discounted by the broader market.
So with everything on the table, what's the final verdict?
When we synthesize the fundamental re-rating, the massive technical breakout, and the impending catalyst of the Windows 10 refresh cycle forcing enterprise upgrades, HP earns a bullish score of 7 out of 10.
7 out of 10, okay.
The elevator pitch is clear. HP is currently positioned at the vanguard of the AI PC supercycle. They are offering a rare blend in today's market, deep value, traditional hardware economics, combined with highly explosive AI-driven growth optionality.
Right. And from an investment timeline perspective, this suggests a medium-term horizon here, roughly in the 6 to 12-month range.
Yeah, that seems right.
That window allows you to capture the full realization of the AI PC product cycle as those NVIDIA-powered machines actually hit the desks, and to see if that anticipated margin expansion actually materializes moving into fiscal year 2026.
You really get to see the story play out.
Yeah, it's definitely a situation that forces you to rethink what a legacy company can become when it catches the exact right technological wave. The company that built the boring beige box on your desk might just be the one putting a cutting-edge computing engine right into your lap.
It's a pretty wild turnaround.
It really is. If you want to build a cleaner stock research workflow, you can check out stockanalysis.com Pro through the link below in the description. Use code ITP for 10% off. Pro comes down to about $5.93 per month when billed annually after the discount. And Unlimited comes down to about $14.93 per month when billed annually after the discount. Remember, stockanalysis.com is a research tool, not financial advice. It does not guarantee investment results, and you should always do your own research before making any investment decision. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you on the next Smart Wealth with Joshua episode.